Hi, I'm Keith Quinn, the Director of Investments at Shoemaker Financial with an economic update for October 2016. In this month's update, we'll discuss some of the events that influenced the markets in September and hopefully help you understand what they could mean for you as an investor. Well, after a fairly uneventful summer, market volatility has definitely picked up over the last several weeks. So let's take a look at a few of the things that are driving this increase in volatility. To begin with, as we've discussed a lot, the timing of the next interest rate hike by the Federal Reserve continues to be a focus of Wall Street and the markets. And the uncertainty over the timing of the next hike has definitely contributed to the increase in volatility because of the impact interest rates have on everything from the economy to corporate profits to the financial markets and consumer finances. But keep in mind, we're talking about a rate hike of 0.25% on the overnight lending rate. Hardly the end of life on earth as we know it, but you wouldn't get that from listening to the financial media. However, at the September meeting, the Federal Reserve once again declined to raise rates, despite noting that the labor market has continued to strengthen and growth of economic activity has picked up from the modest pace seen in the first half of this year. The most recent employment report also came in below expectations, with the economy adding only 156,000 non-farm payroll jobs in September versus the consensus estimate for a gain of 168,000. All of which puts the Fed in a tough spot, because they have to be careful not to leave rates too low and risk overheating the economy as growth picks up, but they also have to be careful not to raise rates too soon or too fast and put the economic recovery at risk. So where does that ultimately leave us? Well, we think it's extremely unlikely that the Fed will raise rates at their next meeting on November 1st, because that's exactly 1 week before the presidential election on the 8th. And the Fed doesn't want to be perceived as doing anything that could potentially impact the election. All of which means to us that if the economy and the labor markets continue to show signs of improvement, the next rate hike will likely be at the December meeting on December 14th. But regardless of when the next hike is, we expect the Federal Reserve and the potential timing of interest rate hikes to continue to be a source of market volatility well into the foreseeable future. Another source of concern for investors has been the slow economic growth in the U.S. And while the third estimate of second quarter GDP growth was revised higher to 1.4%, this is still well below the long-term average of around 3%. But even though 1.4% isn't great, it's still positive growth, and many economists expect growth to accelerate sharply in the third quarter. Another indicator of economic growth is motor vehicle sales. And in September, motor vehicle sales were up 4.7% to an annualized adjusted rate of 17.8 million. But as always, we have to be careful not to read too much into any one economic number, as the devil is often in the details. And in this case, it was in an article by Automotive News, noting that the buying incentives for new vehicles hit an all-time high in September of $3,923 per unit, and that these increased incentives may have resulted in an artificial increase in demand. But even if the sales numbers were somewhat inflated, this is still a great indicator of economic growth. Corporate earnings have also been a major source of concern in 2016. And if the projections are correct, the third quarter will be the 6th consecutive quarter of negative earnings growth. Keep in mind, a major detractor to earnings growth has been the energy sector. And we've recently seen some real progress in oil prices, with West Texas Intermediate climbing back above $50 a barrel, which was at least partly due to the news that the 14 OPEC countries, including Iran this time, have reached a deal to cut oil production by 1 to 2% later this year. And in an even bigger surprise and a great development for oil prices, the Russians announced that they would join with OPEC in cutting production. But as anyone who follows OPEC knows, we'll wait to see if the agreement holds together before giving it too much weight. But the bottom line is that after 6 consecutive quarters of negative earnings growth, we expect earnings to resume growing in the fourth quarter. And last, but certainly not least, has been the uncertainty around the Brexit and the looming U.S. elections. As far as the Brexit, British Prime Minister Theresa May recently announced that the UK will formally invoke Article 50 of the Lisbon Treaty, which begins the 2-year process for leaving the European Union, by no later than the end of March in 2017. And while the British pound sterling has declined significantly as a result of the Brexit fallout, the weaker British currency has been a boon for exports, as a weaker currency makes British exports cheaper on the global market. Now, how about the U.S. election? Who knows? If this election cycle has taught us anything, it's take nothing for granted and rule nothing out, which is part of the problem, because as we've often said, the market hates uncertainty. So ultimately, what does all this mean for us as investors? Well, in a word, volatility. But remember, we think of volatility as being different from risk. we think of risk as the possibility of a permanent loss of capital or the inability to earn a rate of return that outpaces inflation. And volatility is simply the price we must pay to get the long-term returns associated with owning stocks. Well, that's it for this month's update. The next time we talk, we'll have a new president, and at least one of our lingering questions will have been answered. As always, please remember that nothing we've talked about should be taken as an investment recommendation. And if you would like to discuss your personal financial situation in more detail, please give your advisor a call, or you can always call our office at 1-800-757-1059. Until next month, I'm Keith Quinn, the Director of Investments at Shoemaker Financial, wishing you continued peace and prosperity.